Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back with you today with our weekly wrap-up. Graham, what can you tell us about what happened in the market this past week?
Thank you, Stacy. I think the U.S. equities really closed out November with the fifth straight week of gains. So just a powerful movement forward here towards the end of the year. So we saw the S&P and we saw the Nasdaq both up. S&P up about 0.8%. The Nasdaq closed up about 0.4%. But the real leader was probably the laggard of previous, and that was the Russell 2000. That was up over 3%. So we did see 10 of the 11 S&P sectors higher. That was led by real estate, industrials, materials, and communications, kind of set in more of a negative territory over this last week. Crude oil, kind of gyrated back and forth, with some of the expectation of OPEC, their delay in their meeting, and what amounts that the Saudi Arabia and Russia might do in terms of cuts. When you look over to the Federal Reserve or the federal governors, basically their statement was that policy was well positioned to slow the economy and to get inflation back down to 2%. If we look at some other economic numbers like the Core PCE, that hit its lowest reading in 2 years at about 3.5%. So it doesn't look like that side is heating up or overheating. So that's good for inflation. It's not necessarily good for a growing economy, but it might be good for inflation is slowing a little bit. We saw the U.S. personal spending and income figures came in pretty much around consensus. If we kind of look a little bit overseas and we start to look at some CPI numbers, because now we got to think about globally. We saw the Eurozone year over year, their CPI ticked down from about 2.9% to 2.4%. Japan ticked down to 3%. We saw Australia down. We're seeing that just really across the board. All the inflation numbers are ticking down. It's not a question of that. That ticked down over in Australia to about 4.9%. If we look at some spending numbers in terms of Black Friday, the online sales numbers, listen, they reached a record at 9.7 billion. That was up 7.5% year over year. In-person sales also rose up about 1%. So that's given us obviously a very clear statement that the consumer, maybe less in the bank, is still willing to spend as long as they feel comfortable. So that can, not necessarily help inflation, but it's just mindful that we still have a strong consumer that's willing to spend. Consumer confidence rose both in the United States and Germany, I think, because we are seeing some of those inflation numbers coming down. Maybe the fear that the International Fed and our Federal Reserve Open Market Committee maybe doesn't have to be as aggressive with rates. Maybe some lack of or maybe less nervousness that we're going to maybe go into a deeper recession. Maybe it might be something like a soft landing or a light one or no recession. Right. But U.S. new and pending home sales, they really still disappointed. They dropped about 5.6%.
Okay. Well, Graham, it feels like there's been some rotation in the market. What do you think about that?
Well, I think you're right on. I think you are starting to see that. I think, which would be natural, right? We got 500 stocks that made up the S&P index. And just to remind everyone, it might not be exact numbers I'm throwing out, but 7 of the 500, so that left 493 somewhere out there, usually flat to down or slightly up on the year. Well, 7 that make up almost 28% really ruled the roost. That really propelled the S&P up about 20%. Where one stock, NVIDIA, I think it made up 15% of the S&P's return. So you got a really concentrated performance from a very small group that has really moved the markets. Now, that number is a little more broad than that, but that's pretty right on for those 7. So we think the market's going to broaden out. We think the underperformers will start getting some love. Maybe a little money coming out of the ones that have outperformed, maybe rotating into the underperformers. But we still think the solid outperformers, great quality companies will still stay in fashion. Just maybe the performance is a little bit less going into 24 as it was in 23.
All right. Well, thank you so much for that information, Graham. And thanks to our viewers for joining us today. Just a quick reminder, we have already made plans for our upcoming Lunch and Learn webinar that will be taking place in the month of December, and we'll certainly provide you with all of the details, the whens and the wheres and the hows to tune into that. But make plans to join us. We'll be touching on what Graham just mentioned a moment ago about the haves and the have-nots in the market, and perhaps what has worked and maybe what hasn't worked. And you're not going to want to miss it. Thanks so much for joining us today for this weekly wrap up, and we'll look forward to seeing you again next week. Have a great week.
Take care.